Thank you so much for that warm introduction. It's a pleasure to be here with you all today. This is the third part of our series. The first focused on the importance of women having a voice and in control of their finances. We talked about financial mindfulness and financial wellness. The second in our series focused on building your financial house and the basics you need to have in place for financial security. Today, we're going to talk more about retirement planning and what it takes to reach your financial freedom. And I want to mention that the information we're providing today is for educational purposes only. It is not investment, tax, or legal advice. So I always encourage viewers to consult with a qualified professional regarding how to apply this information to your specific situation. So I'll briefly introduce myself. I'm Cassandra Smalley. I'm the founder, owner, and financial joy maker at Cassandra Smalley Wealth Management. I specialize in retirement planning for business owners and high-achieving professionals. I'm a certified financial planner, and I hold the Chartered Financial Analyst designations. Both are considered the gold standard in the financial advice industry, and it's a combination that are held by fewer than 1% of financial advisors. Now, I'm on a mission to do my part to close the gender wealth gap. And so I also wrote a book called The Why of Wealth, Mastering the Steps to a Wealthy Mindset to Live a Joyful Life, to empower women to reach financial freedom. The book has a lot more detail than what we're going to talk about today, but it can be a great resource on your financial journey. So it was written to really grow with you throughout various life stages that we each go through. And whether you're just getting started or you're enjoying retirement, there's stories and helpful strategies and action steps for each stage of life. So let's jump right in. Now, there are some scary statistics out there about the financial status that many people are experiencing. Currently, 21% of Americans have no savings at all. 39% aren't saving for retirement. Even though we see that 79% of Americans should have access to a 401k plan through their employers. Americans today believe that they will need $1.46 million for retirement. But 2 out of 5 people couldn't afford an emergency expense of $400. Less than half of Americans have calculated how much they will need for retirement. There are a lot of moving parts that go into this. We are just going to scratch the surface here today to give you a very basic understanding of what it may take to get there. But after our session, you will be on the positive side of this statistic, and that makes my heart happy. So today we're going to talk about maximizing different account types and what I'm going to refer to as a multi-bucket strategy. This is part of the building phase of retirement planning. Then we're going to touch on the basics of Social Security as part of a retirement income plan. So that way you can make smart decisions about your claiming strategy. And then finally, we're going to do some high-level calculations of your retirement number, and I have some examples that we'll go through, and that will help you see what may be needed to reach financial freedom. So I want to start by sharing a few thoughts about retirement planning. Retirement planning starts the moment you earned your first paycheck. This is when you should start thinking about retirement. Although most people don't start thinking about it until they're well into their career, but tax withholding, Social Security, and therefore retirement planning, those are all happening to you whether you are being proactive or not. Retirement planning continues beyond your life when you consider how your legacy and your wealth is going to transfer and live on, how estate laws will change over time, and tax laws change over time. The actions you take or do not take affect those who will inherit or step in for you in the future. Now, retirement planning, it's not an exact science. We could run spreadsheets all day long, and it does help us spot opportunities. But we will never predict with 100% accuracy exactly how life will pan out. Just think about where you were 5 years ago. Did you know you'd be exactly where you are today? We won't know exactly how the market will perform, exactly what the inflation rates are going to be, or how other factors might come into play. Retirement planning evolves as our life changes, as laws and taxes change, and as money ebbs and flows. This is why it's really a year-by-year process that does need continuous updating. It's based on what's going on in your life at the moment. Good retirement planning requires good tax planning. Believe it or not, there is a tax planning component to every financial decision you make. And the more you know about tax planning or work with someone who could help you implement good tax planning into your financial plan, the more proactive you can be in controlling the tax impact on your wealth. Now, taxes are going to be one of the largest expenses throughout your life. The more you can help manage it and minimize it, the better. Now, most people think planning is all about the numbers, but money is very emotional. It's a very emotional part of our life, and especially as we age. Having a sense of purpose, maintaining social connections, having a reason to wake up in the morning beyond just sitting in front of the TV all day, these are all part of retirement planning too. Now, a lot of retirees face a culture shock after working 40 plus years and all of a sudden quitting. It can be even more emotional for business owners who sell and transition out. It can feel like a loss of identity. And it can be a shock on your relationships as we see a rising number of gray divorce. There are also important connections and life planning conversations that should be happening, as studies have shown that your social connectedness in retirement, it truly does impact your happiness. It affects your health in retirement. And ultimately, that affects your longevity in retirement. Anything involving our health and longevity as we age influences the amount of resources we need to sustain our lifestyles beyond those working years. Now, effective tax planning is an important aspect of building a robust retirement strategy. And by utilizing different account types, taxable, tax deferred, and tax free, you can gain a greater control, greater flexibility over the tax treatment of your investments. These are the three buckets that we're going to talk about in this session, the three main buckets, plus also a health savings account. Although not everyone is going to have access to one, we'll still talk about that one, but not everyone has access to it. So tax deferred accounts include things like traditional IRAs and 401ks. These are pre-tax accounts. If you contribute through your employer, the money that goes into those 401k plans, it's subtracted from your wages before the taxes are taken out. You can also contribute to individual retirement accounts or IRAs. And if you contribute to an IRA, you would likely take a deduction on your income taxes when you file your return. So that ability to take that deduction depends on your income level. The money inside these IRA and 401k accounts can then be invested. While it's inside that account, all of that growth that it's earning while it's in there is sheltered from taxes until the moment that you decide to take the money out as a withdrawal. The money that's then withdrawn in your retirement years now will show up as income when you take that money out. There is a 10% penalty if you withdraw before age 59 and a half, as this money is designed to encourage you to save and invest for retirement. That's why the IRS gave you that deduction in the first place. In a 401k plan in 2024, you can save up to $23,000 this year. And your employer may have matching or profit sharing contributions on top of that. And that's to encourage you to save even more and reward you as an employee when the company is doing well. In an IRA, those limits are $7,000. But if you're over age 50, the government encourages catch-up contributions. In 401k plans, if you're over 50, you can contribute an extra $7,500 in 2024, and in IRAs, you can contribute an extra $1,000. Tax-free accounts on the other hand, these are Roth IRAs and Roth 401ks, which kind of work in opposite of the traditional pre-tax accounts we just talked about. You already paid the taxes before the money went in. So as long as you meet the holding period requirements, the growth is not taxed when it's taken out. And many retirees appreciate having Roth IRAs and Roth 401ks because there's no required minimum distributions. And all the money within that account that has grown much larger, hopefully over the course of your career, it's not going to be taxed again when you take it out to live on in retirement. Health savings accounts are triple tax exempt. And these are one of the best investment vehicles to save for future medical expenses. Money goes into these accounts pre-tax. Any growth inside the account is not taxed. And then when it's withdrawn for qualified medical expenses, the money comes out tax-free. This is the best of all worlds. Now, you must have a qualified high deductible health plan in order to contribute to an HSA. The contribution limits for 2024 are $4,150 for an individual, or if you have a family plan, you can contribute up to $8,300. There are also catch-up contributions for those over age 55. So to elaborate a little more on these plans, as long as the qualifying medical expense occurred after you established the HSA, reimbursement from the HSA account can happen at any point in that person's life. It doesn't have to be the same year. If you receive distributions for any other reasons, the amount you withdraw will be subject to income tax and may be subject to an extra 20% penalty. But you don't have to make withdrawals from your HSA each year. This could be expenses you paid years ago. When we're fast forwarding into the future and kind of looking back, it could be expenses that you paid decades ago, as long as you kept receipts to prove that it was a qualified withdrawal. So think about things like Medicare premiums, out-of-pocket expenses, surgeries. As long as it's qualified, it will work. Now, Fidelity actually measured the average cost of medical expenses expected of a 65-year-old couple retiring today and said that they expect the average couple, the average retiree, to spend $315,000 on healthcare expenses alone in retirement. So the practical planning tip here is to consider maximizing your funding options on HSA accounts, on health savings accounts, invest them for the future, and let them accumulate to cover your medical expenses in retirement tax-free. Taxable investment accounts are taxed on dividends, interest, and capital gains. This is a non-retirement account. But don't forget about saving to this account as well. And there's a couple of points I want to make here. First, there's no contribution limits on these accounts. You can save as much as you want. There are no age-based distribution restrictions. You can use the money at any point in your lifetime. Now, these should be invested tax efficiently by minimizing ordinary income, and that comes from interest or non-qualified dividends. Also, you do not want to sell within the first 12 months to avoid those higher short-term capital gains taxes. The benefit of holding investments for at least a year is that long-term capital gains are taxed at reduced rates compared to income tax brackets. Oftentimes, individuals who are savers, they end up saving so much money in their tax-deferred accounts, like 401ks, that by the time they reach retirement and need to withdraw, they are shocked at how that impacts them on the tax side. Because those RMDs, those required minimum distributions, become larger and larger with age, it can actually throw you into a higher tax bracket even when you're not working. It can cause Social Security to be taxed more, and it can dramatically increase your Medicare premiums. This is also what can happen when one loses a spouse and you change from filing a joint tax return to filing as a single person. But so commonly I see people who own investments that kind of look like this donut chart where the bulk is in their tax deferred accounts. But the goal is to kind of balance them out a little bit over our careers and into retirement. So we have a little bit better control over the tax treatment of our dollars when we need them. So a better solution is to try and build these tax-free accounts when it makes sense to do so, and have some funds in a brokerage account so you can access those funds in pre-retirement years if needed, and ideally build up that HSA that's never taxed for future medical expenses if you have access to it. So as you begin your planning strategy, your practical planning tip here is to consider how you are building these accounts up over time so that you have better control and flexibility over the tax treatment of your dollars in the future. But there's value in having tax diversity and having money that won't be subject to taxes. So it's important to compare your tax rate now to your expected tax rate in the future. If you're in the top tax bracket now, pre-tax is often better for those individuals. For others, Roth can be more advantageous. But you might also consider that we are in a period of historically low tax rates. So for some individuals, these historically lower tax brackets encourages them to build up those Roth accounts, even if they are in those higher brackets, because they don't expect them to be much lower for them in the future. Or perhaps it could be a legacy planning tool to pass on tax-free wealth to that next generation. I get this question a lot. Does it make sense to do Roth conversions? Roth conversions are a way to strategically get more money in that tax-free bucket to help minimize the taxes you pay on those dollars. Often the ideal time to convert money, I see it happen a lot in your 60s, kind of after you retire, but before those required minimum distributions kick in. Tax planning should be a big part of your retirement planning strategy. And I have a few slides sprinkled in that show what it looks like within my planning software. On the right-hand side, what you're seeing is the current tax allocation or the tax mix between each of those three main buckets that we talked about a little bit earlier. On the left is what it looks like when we did the Roth conversion strategy in this example. We convert money from those pre-tax accounts into those Roth accounts, proactively paying the taxes at a lower tax rate. Now, I haven't met anyone who was disappointed they had so much money in their tax-free bucket, so I will say that. But also consider how this may look for you as you're building your accounts over your career. When might be that optimal time for you to consider a Roth conversion? And does that make sense? So this was an example where we modeled filling up the 22% tax bracket, or what's projected to be the 25% bracket if taxes revert. Each of those horizontal colored lines are the different tax rates. The blue area is income. So it's showing what tax bracket you are hitting based on how high your income is. And you can see in this example, the individual's working for a few more years, then they retire. So the blue shaded area goes away. And then those required distributions and other income sources kick in. And so their income starts to ramp back up again. And that's why they're hitting those higher tax brackets. And you can see where that green shaded area is in the middle. That's where we're planning to be proactive and pay those taxes now at those lower rates before those required minimum distributions set in their 70s, which would force them into those higher brackets. In this example, it is showing that it's going to add money to their overall investment portfolio by being proactive and strategically paying the taxes in those lower tax rate years. Now, this table summarizes where the tax benefit is for each account, whether that's on the contribution, whether that's on the growth while it's sheltered inside the account, whether it's tax-free on the withdrawal, or as in the brokerage account, its favorable tax treatment can be on those long-term capital gains and qualified dividends. But next, we're going to talk about a simple way to kind of bring all of this together, help you calculate your retirement income need in the future. We're going to talk a little bit about Social Security, when and how to claim for that maximum benefit. Most people that I talk to in their mid-careers today, they don't have access to pension plans like they used to. So if you do, so a couple of things to keep in mind, a few important factors you want to consider. is what those various options are and those various payouts look like. What survivor benefits are available. Calculate how a lump sum payout versus monthly income will impact your plan. And consider what the financial position is of the pension fund itself and whether or not that's underfunded. We want to make sure that that pension plan is going to be around to pay out that monthly benefit for the longevity of our retirement. Then we're going to talk about taking investment withdrawals from your portfolio and the commonly talked about, in quotations, the 4% rule. Social Security benefits can start anywhere from age 62 to age 70. Benefits are based on your highest 35 working years, and those highest 35 working years are then indexed for inflation. That means if you have a few years of zeros, working a few extra years to knock out those years of zeros could make a big impact on your lifetime benefit. The later benefits are started, the higher they will be for life plus inflation. You will receive an 8% increase for each year that you wait to collect. This is the only place that will guarantee you an 8% increase in your benefit. Now, I am actually not a fan of the way Social Security presents benefits to individuals because I think it encourages more people to claim early. And that can be detrimental to a long life expectancy. If you wait to claim and start your benefits at age 70, your benefit will be approximately 77% larger than if you had started at age 62. That is a huge difference. Plus, then they add inflation factors on top of it. For married couples, when the first spouse dies, the survivor is going to keep the higher benefit. This is an extremely important conversation when I'm doing retirement planning for a couple, because the goal is to ensure that the longest survivor will have enough income to support themselves as well. And this is why it can be super beneficial to delay that higher benefit and start the second lower one at full retirement age, if that income is needed earlier. Which, going forward, full retirement age is age 67 if you were born in 1960 or later. Now, this shows an example why I'm not a fan of the way Social Security presents your benefit. Because by showing you the monthly benefit, not the annual or potential lifetime benefits, you may not realize how much of a difference claiming early can hurt. So this is a sample that shows the difference in lifetime Social Security benefits with inflation adjustments between claiming at retirement versus age 70. The difference on when to claim can be based on many qualitative and qualitative factors, but it's important for you to see these trade-offs before making decisions that will affect you for the next 30 years. There are also some important planning considerations and some strategies that you should be aware of if you've ever been divorced. Now, you will qualify for an ex-spouse benefit if you were married for at least 10 years and your ex qualifies for those retirement benefits. You have to be at least 62 years old, and it's only going to work if your own benefit is actually less than 50% of your ex-spouse's benefit. You cannot be currently married, or if you did remarry, it must be after age 60. You can file for this benefit as long as you had been divorced for at least 2 years before applying. Now, your benefit is actually going to be less than 50% of your ex's benefit if you file before your full retirement age. There is still a penalty in place. So it'll be less than 50% depending on how early you claim. But you should know that if your ex is deceased, your benefit will now be 100% of your ex's benefit because now it converts to a survivor's benefit. Now, you may be wondering, how much money do I need to retire? And I will say there's no perfect magic number. My crystal ball is in the shop today, so I can't tell you how to have just enough so you spend your very last dollar. There is a basic framework that we can work with, though, and that's what we're going to discuss. So keep in mind, I still say you need to review this with a financial planner who can run these Monte Carlo projections. What they're basically doing is running thousands of different market simulations. They can stress test different scenarios, and it gives you a better sense of whether or not you're on track. That will help you identify any blind spots you may not realize within your plan. So this is an important part of the retirement planning process. But the first thing you have to know of is what your future expenses are going to be. So we talked about reviewing your spending needs and building that emergency fund of 3 to 6 months of your living expenses from our last session. So now that you have that current monthly expense, we want to start by how much you're spending today, get that into an annual rate, then inflate that into the future. And there are online calculators that can help you with the math with us. The second step is then subtract out those guaranteed income sources, things like pensions and Social Security benefits. Then multiply that annual shortfall by 25. This is the 4% rule, that 4% guideline in reverse. And that will give you a rough savings target for the start of retirement, how to know if you have enough saved up. And that assumes you will need 30 years of withdrawals. Now, I say 30 years because if you watched our first session, you saw that there is approximately a 1 in 3 chance that a woman would see age 95. So a 65-year-old should plan for that longevity and ensuring they have 30 years of withdrawals unless they have a terminal illness. And as I'm building out retirement plans for my clients, I love to use visuals to see where money is flowing into and out of the home. It really helps ensure we've kind of captured all those expenses to see if there's a surplus or deficit. This is a waterfall graphic that I use. I can actually fast forward and see it year by year on a high level, where cash flow is going within that household. Now, please keep in mind, the 4% rule, like I've said, is not really a rule. It's more of a guideline. But studies have been done to look throughout our history of what could be a reasonable withdrawal rate, or so-called safe withdrawal rate, to ensure you don't run out of money before you run out of time. 4% seemed to be that standard that worked over most 30-year time horizons throughout our history. So the way this calculation works, you would take out 4% in your first year of retirement and then adjust it by the amount of inflation each year. So just to make the math easy, on a $1 million investment portfolio, you could pull out 4% or $40,000 in year one. Then in year two, let's say inflation was 3%. You would take out $40,000, multiply that by 1.03, 3% inflation, and that would give you $41,200. You could continue doing that each of those 30 years. And this theory assumes that if you are invested, this is an important part, if you're invested in a balanced portfolio of stocks and bonds, and you rebalance your portfolio each year, also an important part of this, you can see in this example, over this time horizon, 4% and 5% worked. But anything greater than that, they ran out of money. And when they did the research on this, they did that over 30-year periods throughout history. And 4% worked the vast majority of the time. So that's where we get the safe withdrawal rate. When we bring all this together, living expenses, taxes, housing, healthcare, and other goals like vacations, a car every few years, perhaps we're gifting to kids or grandkids or charity, we can see what the total cost of retirement might look like over a 30-year period and why building that retirement plan is so important. Staying invested is so important. This is likely your biggest asset, your biggest resource. You don't want to make it harder on yourself to enjoy those retirement years by cutting corners or delaying when you start planning and investing for your retirement. So let's look at another example of how all of these calculations come together to build that basic retirement income plan. Let's say I calculate that I need about $150,000 in expenses when I retire in my 60s, using just an average inflation rate. So I logged in to Social Security, and based on my earnings history, I'm just going to keep the math easy. If I continue to work and earn at the same pace, let's say my benefits are $50,000. That means I would need to withdraw $100,000 from my investment portfolio each year in order to maintain my standard of living. Using that 4% rule, which works out to the same idea as multiplying by 25, my investment portfolio in this example would say it would need to be $2.5 million. This would allow me to continue to withdraw $100,000 and adjust my withdrawals each year for inflation. Now, should I plan to retire early in my 50s and therefore I might expect a retirement much longer than 30 years? I may also need a larger portfolio. I would also need to probably count for healthcare expenses before Medicare age. Or perhaps I would just need to withdraw a smaller percentage to ensure that that same safety nest egg will be available in my elder years. But next, I want to draw your attention to just some common mistakes or thought processes that I see others make when thinking about retirement planning. One thing that's often overlooked is inflation. What you need to live on today will likely double, perhaps even twice over in retirement. Often we see people missing the expected cost of healthcare expenses. Future medical expenses and long-term care needs are very expensive. Underestimating life expectancy and the impact on retirement funds. Or perhaps just being overly conservative with investments, holding on to too much cash, CDs, or being too conservative too young. Starting too late, missing out on those benefits of compound interest. Starting early allows your money more time to grow, making it much easier to reach those retirement goals. Not taking advantage of employer matching programs and leaving free money on the table. Failing to diversify investments. I've seen this happen where we're concentrating investments in a single stock, like an employer stock, or something you inherited from a family member, or because the company's done so well, you just can't seem to unmarry it. Those concentrations increase risk and the chance that something could go wrong in your retirement plan. Even underestimating retirement expenses. People often assume that their expenses are going to drop significantly in retirement, but costs like healthcare, travel, and even hobbies that you're going to pick up now that you're not at work all day can be higher than expected. Taking those early withdrawals, relying too much on Social Security. Social Security was not designed to be the sole source of retirement income. In fact, its purpose was to keep people out of poverty, not provide for the luxuries of life that you and I have all become accustomed to. So relying too heavily on Social Security without other savings can lead to that significant shortfall. And that's one reason I believe you see a lot of retirees return to the workforce. They need a little extra income. Failing to adjust savings as your income is increasing, not having contingency plans for things like job loss, disability, economic downturns, falling prey to expensive insurance gimmicks. I've seen that happen. Chasing the fad of the day, or making excuses. I've seen people say, I'm just not good with money, or my spouse or partner handles that, so I don't have to worry about it, or that they'll just get around to it later. That kind of thinking can make it a lot harder on yourself when you finally decide to take charge. But I know everyone here is not one of those statistics. So you're investing in yourself today and you're being proactive about your retirement planning. But here's a couple other tips for saving more for retirement. And one thing I want you to think about is always paying yourself first. Set aside retirement savings before paying any other expenses. Automatically increase those contributions by at least 1% each year with the goal of aiming for 15 to 20% of your income. 401ks often allow you to set up those automatic escalation features. And you can also save part of your annual raise or bonus, automatically deducting contributions from your paycheck into your investment and retirement accounts. And always, always, always take advantage of employer matching. This is free money. Also consider when you're paying off a debt, now you can use some of that monthly expense that you were paying towards it to now increase your savings rate. So I know retirement planning and tax planning can get complicated. Changes in the market, inflation rates, the economy, tax laws, changes in life in general, they require us to constantly update our plans. Today, you learned several different strategies to help you build your retirement plan and calculate what it may take to get there. So I invite you to schedule a consultation if you'd like to talk about your specific situation, how I might be able to help you reach your retirement investment goals. There's a QR code on the page that'll help you set that up. And thanks for joining us today.